Some of the most exciting technology opportunities aren't in Silicon Valley, they're right here in Canada. The Toronto Stock Exchange has quietly become home to some of the most innovative software, AI, and digital infrastructure companies in the world. While most investors focus on US giants like Microsoft or Nvidia, Canadian tech often flies under the radar, even though many of these companies are growing just as fast, often with stronger balance sheets and less hype. In this video, we're counting down top 7 Canadian tech stocks with massive upside heading into 2026, ranked by their growth potential, profitability, and long-term staying power. If you find value in these deep dives, make sure to like the video and subscribe to Bucks and Beyond, where we break down both US and Canadian stocks with investor mindset, not hype. Let's dive in. At number 7, we have OpenText, ticker symbol OTEX. OpenText is one of Canada's oldest and most established tech companies, often called the digital librarian for global enterprises. Its software helps businesses manage, organize, and secure massive volume of information across documents, cloud data, and AI workflows. This isn't the kind of flashy company that makes headlines, but is quietly one of the most important. Over the past years, OpenText has gone through a major transformation. It has been aggressively acquiring cloud and cybersecurity firms to expand its platform, and that strategy is paying off. Cloud bookings surged 32% in the last reported quarter, and management has boosted the quarterly dividend by 5%, confirming a shift towards combining growth with shareholder returns. What makes OpenText particularly interesting is that it offers both stability and upside, strong recurring revenue through enterprise clients, and critical exposure to AI-driven digital transformation through its new Titanium X platform. The stock has been trading in a consolidation pattern, largely because investors have been rotating out of defense software into high-growth AI plays. But OpenText's fundamentals remain rock solid, and its valuation is much lower than US peers like Oracle or IBM. If interest rates ease into 2026, OpenText could be one of the first Canadian tech names to see multiple expansion. For long-term investors, this is a stock you buy quietly and let compound. At number 6, we have Lightspeed Commerce, ticker LSPD. Lightspeed Commerce is a fascinating turnaround story. Based in Montreal, the company builds software that helps small business and mid-sized businesses manage sales, inventory, and payments across both online and in-store channels. After its IPO in 2029, the stock skyrocketed, then crashed more than 80% when growth slowed and profitably vanished. But today, Lightspeed looks very different. Management has shifted focus toward profitable, sustainable growth. Adjusted EBITDA has finally turned positive. Cash burn is down significantly, and average revenue per user is up impressive 19% year over year. The company is also simplifying its operations, existing low-margin segments, and integrating more payment solutions, which have higher recurring revenue. And here's the kicker. They've been authorized a large share buyback, a confident move that signals management believes the stock is undervalued. Lightspeed's share price has been in a sideways channel, as the market doesn't fully trust the turnaround yet. But that's exactly when opportunities often form. As cash flow continues improving, any solid earnings beat could trigger a sharp re-rating. For patient investors, scaling in during weakness could pay off handsomely if Lightspeed executes on its multi-year plan. At number 5, we have Docebo, ticker DCBO. Docebo is an AI-powered corporate learning platform that's becoming essential for modern enterprises. Think of it as the Netflix for employee training, powered by algorithms that adapt to each learner. As companies around the world reskill workers for the AI era, Docebo's value proposition is skyrocketing. The company's annual recurring revenue recently surpassed $230 million, and gross margins are constantly above 80%, elite levels for mid-cap software stock. Docebo has also achieved GAAP profitability, a major milestone that puts it on the radar for institutional investors looking for scalable SaaS play. They have even achieved FedRAMP certification in the US, which opens doors to lucrative government contracts, a rare edge for a Canadian tech firm. After a powerful rally earlier this year, Docebo has seen some volatility, part of a broader correction in mid-cap growth stocks. But the fundamentals haven't changed. This is a company with sticky recurring revenue and strong pricing power. If AI spending continues accelerating into 2026, Docebo could easily reclaim its highs and move higher. For long-term investors, small dips like this are opportunities, not red flags. At number 4, we have Kinaxis, ticker KXS. Kinaxis is Canada's global leader in AI-powered supply chain management. Its software platform called Rapid Response helps major corporations plan production, forecast demand, and respond to disruption in real time. From automakers to pharmaceutical giants, Kinaxis clients rely on its software to keep their supply chains running smoothly, especially during unpredictable times. Over the past years, Kinaxis have expanded aggressively into Asia and Europe, diversifying its client base and increasing its recurring revenue. Its margins are solid, its balance sheet is strong, and AI integration is unlocking new efficiency and forecasting capabilities. The company recently raised its full-year SaaS revenue guidance to reflect strengthening demand, proving strong execution. In many ways, Kinaxis has become infrastructure for global trade. Kinaxis stock has been showing a strong base, and institutional buying has quietly resumed following the positive earnings and guidance. If the next quarterly report continues this revenue acceleration trend, Kinaxis could easily break out to new highs. This is the type of company that doesn't just survive economic uncertainty. It benefits from the complexity and disruption that drive demand for its service. At number 3, we have Shopify, ticker SHOP. Shopify needs little introduction. It is Canada's tech crown jewel and one of the most influential e-commerce platforms on the planet. After years of prioritizing growth, Shopify has shifted its focus towards profitability, and that pivot has completely changed investor sentiment. The company's revenue growth remains robust at 27% year over year, and it generated $363 million in cash flow last quarter with a healthy 15% margin. They have streamlined operations, exited the logistic business, and doubled down on high-margin merchant services and subscription. What's especially exciting is Shopify's expansion into AI-driven commerce tools that help merchants automate marketing, product description, and inventory decisions. They're also courting large enterprise clients, positioning themselves beyond small businesses and moving closer to Salesforce territory. Shopify stock has rebounded strongly off its recent lows and trades at all-time highs. Short-term pullbacks are likely as traders take profits, but long-term fundamentals look strong. If inflation keeps easing and rate cuts continue, Shopify could reemerge as one of North America's top-performing large-cap growth names. Long-term investors might see any weakness as a strategic accumulation window. At number 2, we have Constellation Software, ticker CSU. Constellation Software is the Berkshire Hathaway of technology. Its model is simple, but genius. It acquires small, profitable software companies that dominate niche industries, then lets them run independently under its massive umbrella. This decentralization structure keeps innovation alive while compounding cash flow year after year. With well over 1,000 businesses in its portfolio, Constellation has quietly built a global empire that spans utilities, education, healthcare, and public administration. The company's track record is stunning. Consistent double-digit growth, minimal debt, and a management team that reinvests every dollar with discipline. In a market obsessed with hype, Constellation is the definition of boring brilliance. Constellation shares rarely trade at a discount, but any pause in momentum is when institutions accumulate shares. Given its incredible consistency, Constellation remains one of the most reliable compounders in Canada. Perfect for investors who think in decades, not quarters. At number 1, we have Celestica, ticker CLS, the ultimate Canadian AI infrastructure play. For years, Celestica was known as low-margin electronic assembler, but that's old history. Today, it has reinvented itself as a critical player in AI data center hardware, cloud networking, and defense systems. Its connectivity and cloud solutions division is building high-speed infrastructure that powers artificial intelligence, while its advanced technology arm provides steady income from defense, industrial, and healthcare clients. The results are stunning. In the last reported quarter, the revenue was $3.19 billion, and non-GAAP adjusted EPS hit a new high of $1.58, leading management to raise its full-year outlook. This is not a speculative AI stock. It's a profitable, growing manufacturer at the heart of the AI boom, which is why the stock is up over 250% year to date. Celestica stock has been on fire, hitting multi-year highs and gaining attention from the major US funds for the first time in years. After such a strong run, some consolidation wouldn't be surprising, but as long as AI and cloud infrastructure spending keeps climbing, Celestica's continually raised guidance supports higher prices in 2026. If it ever dips meaningfully, it could be one of the best buying opportunities in a Canadian tech. And that wraps up our countdown for top 7 Canadian tech stocks with huge upside for 2026. From steady earners like OpenText and Kinaxis, to turnaround stories like Lightspeed, to powerhouses like Shopify, Constellation, and Celestica. This lineup captures the very best of Canada's innovation economy. Which of these names are you most bullish on heading into 2026? Drop your thoughts down below. If you enjoy this breakdown, hit the like button, subscribe to Bucks and Beyond, and turn on notifications so you never miss future deep dives into Canadian and US markets. Thanks for watching, and I'll see you in the next one.